Ever wondered how the stock market works? Well, you're in the right place to find out. Today, we're diving headfirst into the bustling world of stocks, trades, and investments. We'll explore everything from the fundamental basics to the intricate strategies that can help you build and grow your wealth. This is a journey into the heart of finance, a trip down Wall Street, and the beginning of your investment adventure. So grab a pen and paper and prepare to navigate the complexities of the stock market. Before we jump into the nitty-gritty, it's essential to establish a solid foundation. Think of the stock market as a bustling marketplace, a hub of financial activity where buyers and sellers converge. But instead of trading goods and services, they're trading pieces of ownership in publicly listed companies. These pieces of ownership are what we call shares. When you buy a share, you're essentially buying a slice of a company, a stake in their successes and failures. And just like how owning a piece of a pie gives you a claim on the delicious filling and crust, owning shares gives you a claim on the company's assets and earnings. This is the essence of the stock market, a place where ownership in companies is bought, sold, and traded. So remember, when you're buying shares, you're not just buying a piece of paper or a digital asset. Buying shares means you become a shareholder of the company. You might be wondering, why should I invest in stocks? The answer lies in their historical performance. Over the years, stocks have consistently delivered some of the highest returns among various investment options. This isn't to say that the ride is always smooth. There will be ups and downs, but over the long term, the trajectory has generally been upward. Furthermore, stocks have the potential to outpace inflation. In simpler terms, the money you invest today could buy more in the future, preserving your purchasing power. But the real magic happens when we talk about wealth growth. As companies grow and become more profitable, their stock price typically increases, and as a shareholder, you stand to benefit from this growth. This can significantly multiply your initial investment over time. So, investing in stocks isn't just about making quick bucks. It's about securing your financial future. Investing in stocks can be a powerful tool to grow your wealth. Of course, with great reward comes great risk. Venture into the world of investing and you'll quickly realize that the stock market can be a roller coaster ride. Prices swing up and down, sometimes with little warning, and these fluctuations are driven by a myriad of factors. Economic conditions, company performance, global events, even rumors can cause stocks to soar or plummet. However, don't let the element of unpredictability deter you. There are strategies to help manage these risks. One such strategy is diversification. Spreading your investments across different companies, sectors, and geographical locations. It's like not putting all your eggs in one basket. Another key strategy is doing your homework. Thorough research into a company's financials, its competitive position, and the overall market sentiment can provide valuable insights. Remember, knowledge is power. Diversifying your investments and doing thorough research can help manage risk. It's all about striking a balance between the potential for high returns and the risk of losses. Scene script. Stocks come in different shapes and sizes. It's like walking into an ice cream shop and seeing a myriad of flavors. Each one appeals to different taste buds, and in the world of stocks, to different investment strategies. First, we have growth stocks. These belong to companies that are expected to grow at an above-average rate compared to other businesses. These stocks might not pay dividends, as the companies often reinvest profits to fuel further growth. Next up, value stocks. These are shares in companies that are considered undervalued compared to their intrinsic worth. Investors buy these stocks hoping the market will eventually recognize the company's true value, leading to a rise in the stock price. Lastly, we have income stocks. These are shares in companies that regularly pay dividends. They're a favorite among investors who prefer a steady income over potential stock price appreciation. Understanding these categories can help tailor your investment strategy to match your financial goals and risk tolerance. It's crucial to have a clear investment goal and a well-thought-out plan. Imagine you're setting sail on a vast ocean. Without a destination or a navigation chart, you would be drifting aimlessly. Similarly, investing without a goal is like wandering in financial wilderness. So, what might these goals look like? Well, they can be as varied as your life's milestones. You might be investing for retirement, saving for a down payment on a house, or funding your child's education. Each of these goals requires a different approach and timeline. The key here is specificity. Don't just aim to save money, instead determine how much you need, by when, and what kind of returns will help you get there. Remember, your investment plan is your roadmap. It's a tool to keep you focused, disciplined, and resilient in the face of market fluctuations. Having specific goals will guide your investment decisions. Now let's talk about research. The key to making informed decisions in the stock market is thorough and diligent research. Before investing your hard-earned money in a company, it's crucial to get a holistic understanding of its financial standing, the competence of its management team, and its competitive position within the industry. Scrutinizing a company's financial health involves looking at its balance sheet, income statement, and cash flow statement. These financial statements can give you a clear picture of a company's profitability, debt levels, and overall financial stability. Additionally, you must review the company's quarterly and annual earnings reports. These reports provide valuable insights into the company's performance, future plans, and potential challenges. Lastly, don't overlook the importance of keeping up with financial news and trends. Reputable financial news sources can offer you real-time updates and expert analyses that can greatly influence your investment decisions. So remember to utilize financial statements, earnings reports, and reputable financial news sources for a comprehensive view. When it comes to buying and selling stocks, there are different types of orders. Now, what exactly does that mean? Well, let's break it down. At its core, a market order is like an immediate command. It tells your broker to buy or sell a stock at the best available price right away. This means the transaction happens quickly, but the trade-off is that you have no control over the exact price. On the other hand, a limit order gives you more control, letting you specify the price at which you're willing to buy or sell. If the stock doesn't reach your set price, the order won't execute. This method provides price certainty, but there's a chance your order may not go through if the market never hits your target. So when should you use each? Market orders are best when execution speed is crucial, while limit orders shine when you prioritize price over immediacy. Remember, a limit order allows you to set a specific price at which you want to buy or sell. Are you in it for the long haul or looking for quick gains? This is a question you might find yourself grappling with as you delve into the world of investing. It's the classic battle of long-term versus short-term investing. Long-term investing is akin to running a marathon. It's about buying stocks and holding on to them for several years, even decades. This strategy relies on the fundamental principle that despite short-term fluctuations, the stock market tends to rise over time. It's a game of patience and resilience, perfect for those aiming to build wealth for retirement or other long-term goals. On the flip side, short-term investing is more like a sprint. It involves buying and selling stocks within a short time frame, hoping to capitalize on short-lived market trends. It's a more active approach that requires time, skill, and a higher tolerance for risk, suitable for those seeking swift returns. Ultimately, whether you're a marathoner or a sprinter, remember, your strategy should align with your goals. Market indices like the S&P 500 provide a snapshot of the overall market's performance. They represent a section of the stock market and help us gauge its direction. Imagine you're on a boat in the middle of the ocean, and the index is your compass, guiding you through the vast sea of investment opportunities. Now let's shift gears and talk about exchange-traded funds, or ETFs. These are investment funds traded on stock exchanges, similar to individual stocks. They aim to track the performance of a specific index, sector, commodity, or asset. Why should you consider ETFs? Well, they offer a simple way to diversify your portfolio. Instead of picking individual stocks, you're effectively buying a small piece of every company within that index. It's like enjoying a buffet of investments, all served on a single plate. Remember, diversification can help spread risk. So, investing in ETFs could be a smart move for beginners and seasoned investors alike. ETFs allow you to invest in a diversified portfolio of stocks with a single investment. Patience is a virtue in the stock market. It's not just a cliche, it's a fundamental truth that seasoned investors understand well. The market is a complex beast, prone to fluctuations that can shake the resolve of even the most stoic among us. Yet it's these very fluctuations that make patience such a critical aspect of successful investing. When the market takes a dive, it's easy to let fear dictate your actions, but remember, panic selling often leads to regret. On the other hand, when the market soars, Greed can blind you to the risks of overvaluing a stock. Instead, let patience be your guide. Stick to your investment strategy even when the market seems against you. Over time, despite its ups and downs, the market has a tendency to trend upward. So keep your eye on the prize and stay committed to your long-term goals. Avoid emotional decisions and stay focused on your long-term goals. And there you have it, a crash course on the basics of the stock market. From understanding the fundamental principles, recognizing the different types of stocks, to setting clear goals and making informed decisions, we've covered it all. Now it's your turn to step into this exciting world of investing. Remember, patience and knowledge are your best allies on this journey. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more content like this. Until next time, happy investing!